The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. Hello to everyone.
Yeah.
That tickle you did it?
No, I just thought about
What?
you should never look at blogs about your shows.
Oh, I know where you're going.
Somebody wanted to punch me and they said you're a blowhard.
But that's only two out of what?
That's
Tens
right.
of thousands
Out
of
of
listeners.
millions of listeners,
That's
of
right.
course. Don't ever listen to that stuff.
And don't ever look yourself up on the internet unless you have thick skin.
Well, let's talk about the market. What do you think the market's going to do? They ask me this almost every day. What do you think, Guy, the market's going to do the
we've
next few
been
months?
talking about margined accounts. I remember doing shows, 2 years ago, and the writing is on the wall. It's the bull market's got wrinkles and lines, and it's ready to go. So, but the more I read, the more I hear. Right now, they're talking about the pundits, the people that are supposed to know what they're doing, although the market surprises us all. They're predicting a 20% correction, which seems kind of low, right? Because when we have a correction, usually it's 30, 35-ish. And they're saying, no matter who you vote for, Trump, Gary,
Nah, I don't know.
the independent guy, or Hillary, that once the person
Green
gets,
Party people.
yeah. Once they get into office, that the market will correct. What they're stating and the reason it hasn't so far, and there's lots of things and a lot of moving parts, but they noted that $400 to $500 billion has been invested in our markets from foreign concerns. They mentioned that the reason companies are making their earnings right now and doing so well is because the cost of money is so low. What do you think?
I thought you were going to say $400 or $500 billion into Hillary's foundation.
Well,
I didn't realize where you were going with that.
depends what you'd get for it. You'd probably get quite a bit.
No, all I know is you've got. This is a weird thing. This is the weirdest bull market ever. You know, we're going into 7 years now, or whatever. We'll say 8.
About to turn
You've
the
had
corner.
negative outflows out of mutual funds. This is the first time we've had almost 2 years of negative outflows out of mutual funds, but the market's still going up because institutions and foreign money's been flowing into the market, which is unusual. Usually money's flowing out, the market's crashing, but not now. We've also had 6 negative earnings quarters in a row. I believe the last time that happened was December, I think, of 2007. We know what happened in 2008.
Yep.
One of the smartest people I go and listen to him pretty much every year, Scott Meinert. I think he's the chief information officer for Guggenheim. Guggenheim manages a bunch of the biggest institution money out there. This guy can tell you, the GDP of Paraguay. I mean, he's really sharp.
Yeah, at any given date, right?
Oh, I know.
Yeah.
It's like, whoa. But he said it should have corrected a long time ago, obviously. Nothing goes up forever. But he said the government's inability to raise interest rates when they should have
I was going to say that.
has kept it propped up. And even though it should have gone down, he said he could see it possibly staying up another year or going down tomorrow.
Well, it's like
There's no way to know
with
right
the Fed propping it up. Where are you going to put your money? Everyone is seeking yield, and there's no potential anywhere.
And even the yield, people have put more in dividend stocks and preferred stocks.
Sure.
And those yields have crashed because more people have bought them.
That's right.
And so there's not much place to hide. Banks, they put out a 1.5% CD and put a full page ad out on that baby.
I cashed mine out, and I'm glad I did. Hey, I will say, though, and it's always hard to go out on a limb and give hard advice, so you try to qualify it, because inevitably what you say will be wrong. But we've had a good ride on the market right now. It might make sense to take some off of the table. I think the reason, and Victor can confirm it, that the mutual funds are probably doing it is so that they have some cash on hand when things go on sale, i.e. correction. As far as specifically answering, which we can't do, when the market will correct, I think the best answer, and probably the most accurate, is it will correct. It always does. It doesn't go up forever. can't tell you if it'll be this year or right after the election or in the spring, but it will happen. And our philosophy, as we've talked about a lot, is to make sure your hard expenses are taken care of. We do that with an income stream, and it's guaranteed, and they're absolutes. And when that's done, and if you pull a little money off the table, out of the market right now, perhaps to take a look at doing something like that, what it does is it allows the money that you have in the market to be more of a good decision what you do and not an emotional. We talk about not doing things emotionally, because usually we make bad decisions when we make them emotionally.
It's very difficult to separate emotion from your money. I don't care how smart you are, how level-headed you are.
Well, thank you, Victor.
It is very, very difficult. And I'll give you an example. Let's say you believe in the stock market. I'll give an example. I love the stock market. I've been in it for a long time.
Have to have
I've
some.
been managing people's money in the stock market for a long time. But if let's say you retire and you're 100% stock market, you don't believe in anything else, CDs, the banks are crooks, those annuities are terrible, I only like the stock market, and that thing crashes 50% the day you retire, you will pull out of the stock market. You will stay out of the stock market till you die, because you can see the handwriting on the wall. You know you're spending your life savings that took you forever to save. You just saw half of it disappear overnight. You'll stay out of it. That's just the way it is. If you had a plan in place that covered your expenses, maybe you wouldn't pull out at that time. Or maybe you would have had a plan in place, an exit strategy for that portfolio that would have pulled you out before it lost 50%. In other words, that's what we do. Right now is not the time for a buy and hold portfolio, in my opinion. Right now is the time to have an exit strategy. You have to. There's nothing wrong with, like Scott Minerd said, it could be another year or so before the market corrects. So there's nothing wrong with being in the market, in my opinion. But I need an exit strategy. I need a program specifically designed to pull me out when that thing does correct. I don't want to have to call my broker, or people calling me going, okay, it dropped 40%. What are you going to do? What do we do now? Well, stay the course. Buy and hold. It'll come back. You only realize the losses if you sell. No, you already realize the losses. You just hope it comes back. And so that's what we don't want to do. That's what you don't want to do. So have a strategy. And that's what we do here, is we have strategies that protect the assets. If it's in stocks, you got to have a strategy that protects the stock assets or equities, whatever you want to call them.
And I would add, even if you have a strategy, whether through us or through another advisor, there's plenty of good ones out there where you've got your income taken care of, you're still in the market, I would still consider, I know myself and my family are, I think Victor is too, I would still take some money off the table and get ready for the sales. There's going to be a sale, maybe a year, maybe a few months, but when the market corrects, that's the time to get back in
we
and
both
buy
have
things
personal
on sales.
money on the sidelines right now.
Well, I may have too much on the side, but I feel comfortable with that.
Right.
You know?
I know I'm making 0.00001.
Oh,
The
I
bank's
know.
proud of that. And every time I get an ATM withdrawal, they want to charge me $10 or
Oh,
$2
I
or
know.
whatever. I think they charged me $2 to get the ATM. Then my bank charges me $2 for them giving me the.
Hey, speaking of your axis of evil, I see Wells Fargo's gotten in trouble again.
Oh yeah.
Phantom accounts, was it? How can you do that? Wasn't the Dodd-Frank rule and all of that stuff in place and all the money spent to prevent that?
Oh, the banks are yeah.
Anyway, I
Airline.
digress.
My axis of evil, for those of you who haven't listened to the show before, airlines for charging you for every seat. Oh, you want an extra 3 centimeters of room? Oh, that's an upcharge. Oh, you want a sandwich?
Baggage.
Oh, that's an upcharge.
Baggage.
Oh, baggage? Oh, no. Oh, you want to actually bring a shirt to Hawaii? That's going to cost you. Or the electric company, remember they used to charge, they said, we go to natural gas prices. So natural gas prices go up, we have to raise your rate. And they've been down now for 10 years. Well, we can't lower your rate because we don't go by natural gas anymore. And then what was the other one?
Banks.
Bank's another one. We're going to charge you to look at your own money.
Oh, yeah.
If you want tellers, we close down those tellers nowadays. Now I bank at Bank of America. There's like 10 of them around here. Only one still has tellers. And I'm like, well, what's going on here?
Yeah, they don't want you to use the
And if you
brick
do
and
that,
mortar
sometimes
anymore.
some of them upcharge you just to see it talk to a person now. I'm like, give me a break.
But think about it. Seriously, we've had a long run. If you pull the money out right now, or some of it, or part of it, I can assure you, you're not going to get all of the growth, right? But you can't get all of the growth. If you stay in until the market turns and you've got some rule, well, you're going to wait for it to turn down 10%. I can assure you, you'll lose 10%. So it may be a good idea to take some of it and just be prepared for when it does come down so that you're in a buying position.
I'll give you a quick example of one of our stock market strategies that's specifically designed to protect your finances, but let it ride up. If it does take a year, 2 years more to correct, you're still going to continue to earn profits. One of our programs is in every sector of the market. There are 10 sectors of the S&P 500, but if you use ETFs, you'll combine 2, so you get 9 sectors. It also has fixed income and alternatives and stuff like that. Every sector has a moving average. You know, the more volatile, the wider the moving average. If any of those sectors go below its moving average, it's automatically out of that sector. So every single sector is going up, you're in it. But if any one of them goes down, you're automatically out. So you never have to worry about something crashing on you without you being already out of it. We'll talk more about it after the break. Stay with us, folks. Remember, if you have any financial questions or you'd like to talk to us for anything at all, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show, folks. Right before the break, we got pinched with time there, so I'll briefly go over that again. One of our exit strategies is sector rotation. It basically is we keep our accounts of Fidelity, but it's a sector rotation where you're in every sector of the market that's going up. Only if a sector goes below its moving average are you pulled out of that particular sector. Because I'll give you an example. Let's say the market starts crashing, but some sectors are still doing okay. You know, if utilities are still making 5 or 6%, I don't want to be out of the whole market. Some other advisors out there will pull you out of everything, but sometimes I still want to be in good sectors. If fixed income is still doing okay, I want to stay in that. If utilities are still doing okay, I want to stay in that. And so it only takes you out of the sectors that are going down. But that's an automatic protection feature because I'm telling you, the market's gone up 7 years in a row. Unless there's something wrong with you, you know it's going to correct. Nothing ever, I'll give you an example. Go look back in history how many times the market's gone up 8 years in a row.
Oh, yeah.
I've never seen one. I don't think there's ever been one. Somebody says the 90s, the market went up 10 years in a row. It did not.
I think the biggest one, wasn't it, when Reagan got in after the Carter years?
Well, you got a couple times where it went up 6, 7, or what.
Right.
This is, I think, the longest in history or whatever. It will correct. I don't know how much, but you know, I don't think it's going to be 50% like it was 2000 to 2002 or 2008. Banks have more money than they did then. Corporations have more cash. That's why you're seeing a lot of stock buybacks now. But I'm telling you, 20, 30% still would have valuations higher than they should. It's healthy for the market to correct a little bit.
You see Sears and Roebuck? I think they're down to $15 a share from 150 or something.
Yeah, so I definitely would, like I said, would bury your head in the sand, so to speak. The market will correct. Having protection is not a bad thing. Now, when it corrects, buy and hold ain't a bad place to be. But right now, I would have some kind of protection strategy in my thing. Now, the other part of that plan is you got to have some kind of plan to cover income. Remember, as you get close to retirement, I'm saying within 10 years to retirement, you got to start shifting towards the distribution phase of your life rather than the accumulation phase of your life. A lot of people think it's the same. I can have the same investments. Hey, I've done fine, Victor. Thank you for your information, but I've done okay. You don't realize I scoff at Warren Buffett. He's an amateur. I know what I'm doing. His returns, minuscule compared to mine. I have 4 computer screens in front of me right now, laughing at you and every other radio jokester out there because I know what I'm doing. The problem is it doesn't matter if you had 40 years, you're the greatest stock trader in the world. Make one mistake when you're retired, it's over. And so you go into what I call the death spiral. You take a loss. I'll give you an example. Let's say you've always made 20% a year your entire time, which has never happened. I'd like to find this person. I'll hire him in a second, by the way. You need a job. But you made 20% a year your whole time. So you're only going to take 10% a year out of your money, right? You got $1 million, you take $100,000 a year out. Market loses 50% once. You get caught in this deal. You need $100,000 a year to live. So after 1 year, market loses 50. You got 400 grand left, right? So the market only makes 10% the next year. You still only have 330 grand the next year. I was going to say a bad word, but you're sunk.
I think we know where you were
You're
going.
done. You'll have 330. If the market has one more down, it doesn't matter. It's a death spiral you can't get out of. So you got to shift to the distribution phase. And so you the greatest trader in the world, have so much experience, 40 years we said, in this accumulation phase, but you have no experience in the distribution phase of your life. That's why you need help. That's why you need to run a retirement plan. And that retirement plan has to be done. It can't be on Yahoo Finance. It has to be a more comprehensive plan. Right now, we're going to go over an example of such a person. Now, some of these are much more obvious. In other words, I got a person that needs $5,000 a month. They're obviously going to run out in 5 years, the first 5 years of retirement. That's obvious.
Yeah, they've got $100,000 saved up.
Right. This one's not so obvious. At first look, you'd look and say, this couple doesn't have a problem.
They'll never run out of money.
Right. There's no way they can run out. It's impossible. Or here's another thing. People, they don't think they need a plan. They don't think that's necessary because they'll put in an assumed rate of return into a portfolio. There's another mistake. I see it all the time. I see a lot of doctors and pilots do it. I don't know why those particular occupations do it, but I see it a lot. Engineers, I see more of a stress test type. They'll do more of a 0, maybe a 2 or 3, which I think is more accurate. Because what you want to do is you don't want the market to have to make 5 to 10% for you to retire comfortably. You want it to say, what if the market doesn't make a thing? Does that mean I'm eating cat food when I'm 80?
Now,
That's what you want.
We expect the best. All we're saying is plan for the worst. Stress test it. What's the worst possible thing that can happen? And then you back out of there. We always expect the best to happen.
You don't want to go crazy.
And if the best happens, that's easy to deal with.
Right. You don't want to say, if I lose 20% a year, that's not reasonable.
No.
But if you just don't make much, how does your money last if you don't make a lot?
And what's the market made the last 15 years?
4% a year.
With dividends.
That's right. If you do the actual math, the capital appreciation of the market, it's only about 2% a year, believe it or not. The S&P was 1,500 in 2000. It is now 2,100 on the S&P. It's about 2%. But we're going to show you a case study. This is a couple that came in probably 2 months ago, and it looks like they need nothing at all. And we're going to show you some potential holes, and hopefully you'll see something that might fit your particular situation. Remember, if you have any financial questions, you'd like to take advantage of a no-obligation retirement plan, retirement stress test, and Social Security optimization, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today, we're going to go over a case study. This is a couple that came in here not too long ago. And we're going to show you when it's not that obvious that you really are in need of some kind of adjustment to retirement plan, or that you need a retirement plan.
Well, when you extend out inflation and you extend out expenses and you take a thorough look at it, things are a little different than just the simple math in your head.
Right. Okay. Let's say a couple is, I think, 61 and 58. Going to retire in like 5 years. Okay. We figured their Social Security is going to be about $4,000 a month. Well, here's the good news. They're frugal spenders. They're not big spenders. So they only need about $5,000 a month.
4,000. How's that breakdown? How much is the big social and how much is the little Social Security?
I think it was about $2,500 and $1,500.
All right, because there's always one smaller.
That's right.
All right.
And they had a little under $700,000. Okay.
A lot of money.
That's right. So think about this. They only need $1,000 a month from their portfolio.
They have 700.
That's right. That's $700,000. So when you do the math, you're thinking, that's going to last like 50 or 60 years.
12,000 a year divided in two, right?
So they're like, okay, well, we're already about 60 years old. I think we're good to about 120 years old, right? 110. So at first look, well, this couple needs nothing. But this is what I'm telling you most people do. Most financial planners, financial advisors, they'll do some crappy Monte Carlo simulation, or they'll take some average of a mutual fund or a portfolio that they don't even own or didn't own it for the last 50 years. Say, hey, as long as you stick with this, this thing's average 8% a year, you're fine. There's no stress test to that. There's no inflation to that. There's nothing.
And in a perfect world with no deaths, with
That's right.
no inflation, with nothing, they would be right, correct?
That's exactly right.
But we don't live in a perfect world.
That's
We
right.
really don't.
So what we did was we ran this. Now, we got to be fair because we're going to get increases in Social Security, well, hopefully.
Did that happen last year?
No. Well, what you've got is it increased every year but 3 years in history. The problem is 2 of the 3 have been like the last 5 years, 2 of them have been the last 5.
Yes, that's right.
And they're saying it might not go up again next year. Oh, boy. So we take that 4,000 Social Security. Now, let's assume the best first. Let's assume they both live to 100. Okay? Well, their Social Security would get up to like $8,000 a month from that 4,000, which is fantastic.
Yep.
The only negative is, now I'm making it go up 2.5% a year. Historically, inflation's gone up 3.2 for the last 100 years. But I really don't care what happened in 1925 or 29. I don't care. The last 30 years has been about 2.5, 30, 40 years.
You use 2.5?
Yeah, I
Good
use
number.
2.5.
Good number.
Okay, and you can use any number you want. The one number I'd go use at least 2 because you're going to have some kind of cost of living adjustments.
But the point here is we're not using 3, 3.5, 4,
No,
4.5.
that just scares people.
to
It's not
skew it. We're trying to be conservative even with the inflation
That's
number.
right. And so we use the same number with expenses. So they were going to retire in 5 years. Remember, they had 5,000 expenses. So by the time they retire, it's about 5,400. The reason why you have to do inflation with expenses are the same reasons you heard on my radio show a couple of weeks ago. I had a $580 electric bill. I mean,
Water bill, wasn't it? Yeah. I was listening to that show.
No, my electric bill was lower than my water bill.
Yeah, that's crazy.
Oh, I turned it all off. Trust me, it better rain at my house.
Or you're not watering.
I'm gonna have a lot of landscaping die because I'm not paying $600 a month for water.
I'm with you.
But my point is, it's not going to go down. They're not going to start saying, you know something, we're going to lower electric prices everywhere. You know something, we're going to lower your price. You know the hospital charges and your cost of insurance. We're going to lower all of it.
Our profits are just too high this year.
That's right. Everything's going down. The grocery store, Kroger, we're lowering all our prices. It's not going to. So you got to add that. Now, I'm not trying to scare you with that. I'm only going to add 2.5% to this.
Trying to be realistic.
By the time they're 90 years old, right, those expenses of $5,000 are going to be over $10,000 a month. And that's only adding $2,000. So here's the problem.
Realistically, could be higher than that.
That's right. So this couple, even though they're in better shape than 90% of people I see, remember we talked about they only needed $1,000 a month. It should have lasted 50 years. Well, they went broke at 90. Well, 90 for a lot of you people say, well, nobody ever lives to 90.
Yeah, I was going to say, it doesn't sound too bad unless you hit 92.
So even then, we did a stress test. This couple, well, Victor, thank you very much because, yeah, you did open our eyes, but we still lasted till 90. They forgot one other thing. Now, remember, 90% of people aren't this good. What if one of them dies? We took, odds are, the man dies before the woman. You know that old joke? Why do men always die before women? Because they want to. No.
We lost half our audience on that one, Victor.
I'm kidding. All right. Here's what happens. If the husband in this case died at 85, okay, the woman would go broke at 80. Well, we'll talk about that more after we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the Common Sense Investing Show. Today we're doing a case study on a couple that came to our office that on the surface looked like they didn't need any retirement planning. They only needed $1,000 a month or so from their retirement savings. They had almost $700,000 bucks. So on the surface, it should have lasted them 50, 60 years. but they forgot to factor inflation. We put that in. Also gave them no cost of living adjustments on their Social Security. That should have offset. It didn't. But even if they both lived to be 100, they still lasted till 90 years old, which is fantastic.
And we only factored in inflation at that point.
That's right. And so basically they'd have to cut their expenses by 30% if they lived till 90. Now this couple say, well, that's still pretty good. That is honestly better than 90% of the people that come in.
Absolutely.
But cutting your expenses by 30% is if anybody who lives on a budget around here knows 30% is a lot.
And that's if inflation's only 2.5%.
That's right. But now we got to go into real life scenarios. And that's why there's these plans that we prepare for couples and our customers out there are so important because real life happens. Real life, unfortunately, we both don't live to 100. Usually someone passes away. And so if the husband passed away at 85, the wife ran out of money at like 81, okay, when she was 81. And if that happened, she'd have to cut her expenses in half.
And how much Social Security? We talked about it. Instead of $4,000, of course, it's grown with inflation. We're only losing what, $1,400 a month or something?
$1,400, but with the cost of living, you're losing like $2,500 at that time.
At that time.
That's right, because you'll lose the smaller Social Security, but that smaller Social Security has grown to like $2,500.
That's right.
So you're losing a significant piece of your income, your retirement income at that time. And
this is dying with nothing in the bank and having negative cash flow.
That's right.
Cutting your style of living by 30 or 40%. Forget about leaving something for the kids. You may or may not want to leave anything to the kids, but it's nice, right? If you can leave a cushion.
Absolutely. And so this is a couple that looks like they needed nothing, but if any of them died, which is normally what happens, and if the husband died at 80, it was the same thing. It was like 47%. You had to cut your expenses by 47%. The last thing I want to do is pass away. My wife's already going to be distraught. You know,
well, you hope she will.
It's going to take everything for my wife not to be on the bridge. I'm just saying.
Okay.
No, but now I have to cut her expenses in half. I'm telling you, when you live in a home, hopefully the home's paid off at that, that kind of stuff. Cutting your expenses in half means changing your lifestyle completely.
Huge.
And so now this is why even someone on the surface that looks like they don't need anything, everyone needs to have retirement plan numbers ran for them. It needs to be comprehensive. It needs to run different scenarios. It needs to run, first off, an ideal scenario. We both live to 100, 110, whatever. You have to put inflation. You have to put cost of living adjustments onto your Social Security. You have to add into your pensions. You have to make expenses go up with inflation. And then you have to say, okay, what if one of them passes away? And you can do either scenario. What if the husband passes away? What if the wife passes away? And do several scenarios in there and to see how that affects the portfolio. Then you have to stress test things. You can't have a portfolio where the market has to make 5-10% a year for it to survive. That is not a plan. That's a hope.
Absolutely.
That's a wish. And if you go to retirement hoping and wishing, you know what happens? You're eating cat food at 80. Like I told you.
Try to get a loan from the bank on hopes and wishes. I'm planning on making this much next year, and I'm planning on making this much in 5 years.
Right.
Can I borrow $100,000?
And remember, I know people all the time. Really, I have 4 children. They'll spend every retirement dollar they have to get grandkids through college or whatever. Your grandkids can get a loan to go to college. Try to get a loan for your retirement.
Absolutely.
It's impossible. They're like, well, you're a bad risk. You don't have any money. You're 75 years old. It ain't going to happen.
But I've seen the cheat sheet. There's some really good news by planning.
So what we did for this couple is something different, okay? We took about 50-something% of their assets and put it into a guaranteed income stream. We did it a little different because this couple only needed $1,000 a month. We put it into an increasing income stream. This increasing income stream, historically, it wasn't guaranteed, but the worst it ever did is about 4% a year in increasing, okay? That's the worst rolling 10-year history. And what it did for them is it gave them positive cash flow for their entire retirement. And what that did was, instead of them running out at 90 or 80 or 70-something if one of them passed away, that gave them positive cash flow no matter what happened for the rest of their lives. It gave them money in the bank for the rest of their lives. It made it where they never had to change their lifestyle ever which is nice.
So think about that. You've got positive cash flow where you've used 50% of your money to create this income stream. So, common sense, you've got 50% of that money growing for you somewhere. Hopefully you're judicious with it. Each and every year that's earning and it's growing because you don't have to touch it. You're not emotionally involved. You're not going to pull it out of the market after it tanks. It does a lot of peripheral things for you.
Let me give you an example. In the other case, you had to, if someone passed away, like say at 85, the husband passed away at 85, the wife ran out at 80. She was getting about $4,000 a month in Social Security because she lost hers, right? She kept the husband's in this particular situation. She had $9,000 in bills. She was getting $4,000 income. She had to reduce half.
You could make them wait till after the break before you give them the big numbers.
Right.
We're getting pretty close to the break.
Right. Well, in this case, with the increasing income we gave them, they're getting $12,000 a month in income.
There it is.
And they only had $10,000 a month in bills. And so that's what you want. What's a perfect retirement? More comes into the bank account every month than goes out. You never have to spend any of your retirement savings for the rest of your life, no matter what happens. Any of you pass away, Social Security goes away, you always have more money coming in. That's what a perfect retirement is. Don't hesitate to call us if you'd like to take advantage of running a retirement plan for you. There's never a cost or obligation. Our number is 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today, we've done a case study. It's from clients that came in here in the last couple of months that on the surface looked like they didn't need any retirement planning. We talked about, they had almost $700,000, and they only needed $1,000 a month from it because their Social Security is like $4,000, they need $5,000 a month in bills. So that lasts 50, 60 years. And so unless they're going to live to 115, 120, they're not going to have any issues. Well, when we added, inflation to the mix, they still lasted till 90 and that's not having the 700,000. That's having $1 left when they die.
That's right. And then if one passes away early?
That's right. One passed away early. It went back into the 80s and sometime in the 70s. The wife is a little younger, so in the 70s. Well, that could have been an issue, and they had to cut their expenses in half if one of them passed away early. So that became an issue. We showed them how putting a little more than half of their assets into an increasing income stream, it not only guaranteed they could never go broke, but it made positive cash flow for their entire retirement, regardless if one of them passed away or not. And here's even the best part. Remember I said they started with a little under 700,000?
Yep.
If they lived to be 100 years old, they ended with $622,000 in this example.
And had positive cash flow every year to what age?
To 103 and 100. Their income was $15,000 a month if they lived that long. Well, I'm not saying everybody's going to live that long. We're just using an example here. But I'm saying the income kept going up every year till they die as your expenses keep going up. My dad used to buy brand new Cadillacs for $7,000. Try to buy. I remember my uncle wrecked my mom's brand new Carmen Ghia, and they said it was like $2,800.
Oh yeah.
We lived in Preston Hollow there, and driving it down the street, just got it from the dealership. My uncle wrecked it. So you can't do that anymore. New cars cost more than that, right?
Yep.
So inflation will take a bite out of everything. You have to account for it. You can't do simple math with your retirement plans. You cannot have use the same investing, the same way you invest in the accumulation phase as the distribution phase. It's so easy to put this stuff off. Everybody does it. If you're doing fine in your finances, it's so easy to put it off. You can't. If you're within 10 years to retirement, you have to have this stuff done. Remember, there's no cost. There's no obligation. Look at the numbers. See if it makes sense. I have never ran one of these that it didn't make sense. I have people with tens of millions of dollars that don't need anything. Trust me, if you have $100 million, you don't need anything.
That's right.
Unless you're crazy and spend, $50 million a year. But you don't need anything. I've had them say, Victor, getting more income per dollar out of a specific pot of my money. In other words, I want to put an income bucket together. I want to take $4 million. It gives me income normally produced by $20 million. That frees up more money over here. It makes sense to me.
That's exactly
Why don't
right.
I just put $4 million over there, produce the income of 20, and that frees up more income. So even those guys like it.
Because the bottom line is that the end result is they usually have more cash from doing that because they've removed the income, and they have big income requirements.
Here's the desired result of proper retirement planning. Proper retirement planning is positive cash flow through retirement, leaving more money for you in your account, leaving more money for your heirs, never worrying about inflation, all right? Never worrying if one of you passes away. If one of you passes away, how does that affect your retirement?
And besides from that person passing away and having to deal with the expenses and all of that, they don't have to deal, if it's a person that doesn't normally handle the finances in your family, now all of that is solved for them. They've got that income coming in. It continues, spousal continuance. They don't have to worry about the income and where to put the investments and how am I going to get the income that I need.
What does that say? Money doesn't cure everything, or what is it?
Solve all problems?
Yeah, it doesn't solve all problems, but it sure as hell doesn't hurt.
No, that's right.
I always tell people, I said, at one point in my life, my parents got divorced, and I lived in bad parts of town, eating mayonnaise sandwiches for dinner, going through. Then I moved in with my dad and belonged to, 2 country clubs and had 2 cars, and money was better. I don't care what anybody says. So if you can do proper planning and plan to have more, it's better.
And it's not about the money. It's about the retirement and quality of life. Yeah. Absolutely.
So right now you can take positive steps to plan to have things done the right way. You can have the same lifestyle. Some people have already won the race. They already have enough assets to guarantee that they'll never go broke. Yet they want to keep running. I say, hey, once you run the race, take the steps. Make sure you guarantee your retirement until you die. Then the stock market is the greatest place in the world to help combat inflation and everything else you want.
And if you still want to work, we get that, but you just don't have to keep running because of the financial side.
That's right. Remember, call us. We'll be more than happy to go over this. There's never a cost, never obligation. Guy and I have been doing this for 30 years each. Neither one of us have ever had a complaint. I think we have more credentials than almost anybody you'll talk to out there. We're not going to start and get a complaint with you. So you'll have an enjoyable experience meeting with us. Our number is 972-715-2424. Again, 972-715-2424. You're always welcome to go to our website at ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or